But remember, later today too, we'll also hear from the Bank of England's Monetary Policy Committee at their monthly meeting, where they'll decide on UK interest rates. They're not expected to change, of course, because it's still tied in with that policy at the Bank of England of forward guidance, giving us an indication that rates will stay lower for longer. But it's also worth remembering that today marks an important anniversary, 5 years since rates were slashed to their record lows of 0.5%. All of that has been good news for borrowers and people with debts. It's meant that borrowing has been cheaper to pay back. But of course, not so great if you're a saver, because the return on your investments and savings has been pretty dire. Well, let's speak to Simon Rose from Save Our Savers. He's in Westminster for us. Good morning to you. We said there the rate of savings, or the rate of return that you get on your savings, has been pretty dire because interest rates have been slashed so low. It's savers that have missed out here.
It is. I mean, by our calculations, the combination of the decline in interest rates and the effects of inflation have actually cost cash savers in the UK £326 billion over the last 5 years. It's quite a phenomenal transfer of wealth. Essentially, the people who've been prudent, giving up their savings to help those who are borrowing and perhaps even have been financially irresponsible.
Where does that figure come from? It's a pretty huge figure, a significant figure, but it's very difficult to calculate.
Well, we're simply taking the prevailing interest rate before rates started coming down. There's £1.1 trillion of cash savings. That hasn't budged very much in the last 5 years. We're using that, and we're simply using the government's own figure for inflation. It's a relatively simple calculation to make. But of course, if it had been done through tax, there'd be massive protests. You know, it's 5 years since rates came down, but it's 1 year since there was only going to be a 6.5% confiscation in Cyprus. This is a much bigger transfer of wealth, and yet savers really are being ignored by politicians and by the government.
Yeah, but also some would say it's a price to pay for the economy getting back on an even keel. Low rates have meant that people have been able to go out and spend rather than to save. That's helped keep some jobs in the economy. It's helped see the economic recovery that we've got today. Surely that's worth doing, even though it's at the cost of savers.
You cannot get sustained growth from an economy that is funded from consumer spending that's dependent upon debt. It's like building a house without foundations. The only way we get investment for sustained growth is through savings, because it's savings that are used for investment. You build a house without foundations, it may stay up for a little while, but it's not going to stay up forever.
So what would the alternative be, in your view?
We need to actually start encouraging savings again. It's quite appalling that they're being discouraged. It's going to cause all sorts of problems further down the line. So no, interest rates need to start moving now. The economy is getting a little better. They need to go up gradually rather than have to be jerked up if the Bank of England leaves it too long.